Oh, good day. Thanks for joining me. It's Thursday, 1 o'clock. Must be time for a Facebook live stream. Great to see you. So we've got a whole lot of questions again today, so it's great. I love answering questions and happy to do it. So listen, I think we should get stuck straight into it. So remember the live stream today, and the answers may not be appropriate for you because they're general advice. And I don't know your circumstances, so bear that in mind. If you've got any questions as we're going along, please pop them in. I'll try to get to them within the time available. But as I say, there's quite a lot, so we may not get to everything. Let's start with Michael, who says, what are some good technology stocks or ETFs and long-term LICs for kids? My view with this stuff is if you're looking at long-term for children, you really don't need to go for overall ETFs or LICs that are on the whole market that are conservative, because you're talking about a long-term investment. So therefore, you can push the risk out a little bit. The way to do it, I would suggest, is look on the ASX. If you Google ASX exchange traded products, then you'll see lists. There's several lists. There's a number of tabs. One is for ETFs, and there's another tab for LICs. And you can look through those. And what you're looking for, I think, are specifically targeted ones, niche things. So, for example, and this is just an example, BetaShares is the Australian company that has a number of exchange traded funds, ETFs, and it's got some broader ones like ASX 200 and so on, but it's also got some narrow focused ones such as artificial intelligence, cybersecurity and so on. Now, I'm not suggesting you put all your money into one of those necessarily targeted ETFs, but still, a range of those kind of long-term investments I think is a good idea. With the LICs, we highlight a few of them here. We've got a few friends among the LICs. For example, there's Alex Pollock of Loftus Peak, and he is running through 3 tech stocks in our site this week. You'll look at in Investment Ideas on Tuesday. He had a list of tech stocks that you can look at. But look, there are a number of LICs. I've got some money in Thorney Opportunities Fund, which is a listed investment company, and they've also got a Thorney Technology Fund, which is a technology-focused listed investment company. So look, I probably could, I just don't want to go through a whole list of them for you. But I'd suggest it doesn't take much to research a few, find them, particularly on the ASX website, where you can pick out some ones that are kind of long-term, perhaps slightly riskier, but potentially higher return and a better long-term proposition for your kids. Anthony says, since Boral delivered such a blockbuster quarter so unexpectedly, do you think there is much room for upside in the next term? Look, I think there's definitely room for upside. The stockbroking analysts' target prices range from $7.50 to $8. Now, the stock before the result came out, the stock I think was under $6.50. It's now at around $7, so it popped up from $6.50 to $7 after the result. But according to the broking analysts, at least, there is upside room for Boral. I'm not an analyst. I haven't examined the company, but I would say a couple of things about it. One is that it's a good way to get some exposure to the infrastructure boom, both here and in the US. Both America and Australia have to spend, as we know, enormous amounts of money. America, they have to spend it because their infrastructure is falling apart. In Australia, we have to spend lots on infrastructure because of the high levels of immigration here, and as we know, there's a tremendous amount of construction going on. There'll be a bit of a decline in housing construction, but a big boom, I think, in engineering construction. So Boral's a good way to get some exposure to that if you believe in that theme. Secondly, to some extent, the future of Boral is all about fly ash, which is the acquisition they made in the US. I can't remember the name of the company, but it was a big acquisition, and they're now forecasting 25% growth in fly ash revenue next year. So I don't even know what fly ash is. It's something that's used in construction, in concrete. But apparently that's where it's all about. That's what it's all about for Boral. So yeah, it looks like there is upside. I mean, look, it's selling at a premium. I think the PE, from memory, the PE is something like 17 or 18 times. So it's a bit of a premium to the market. So it's not what you'd call a cheap stock. On the other hand, it's in a good spot. It's in a good business. Should get some growth. Barry says, not sure you noticed that Aston Martin is heading for a listing on the LSE, following in the footsteps of Ferrari's listing. It's a strong brand, but has gone bust 7 times in the past. There you go. Any chance of your international fund manager mates doing a pre-IPO review? Okay, I'll take that. I'll put that down on the list. I'd be interested in interviewing the boss of Aston Martin and talking about whether they're going to go bust for an 8th time at some point. That'd be interesting. And they're beautiful cars. I've always wanted to own an Aston Martin. Never been able to afford it though. Maybe one day. Dominic says, we're getting advice regarding labour and franking credits. For example, sell shares with franking, banks shares, etc., still high without franking. So look at the dividend before selling others to get 1 or 2% higher dividend. I agree. I mean, it's true that you know, obviously there's going to be some less appeal for high yielding 100% franked stocks. I do think that if Labor is elected, those stocks will probably come off because of, you know, there'll be less buying as to whether there's selling. Maybe there's some selling as well. But I do think that a lot of the stuff is overblown about it. You need to make a decision, an investment decision, based not on tax but on you know, whether it's a good investment or not, it seems to me. Anthony says RCR got smashed this morning, last Thursday, after a CR capital raising. Do you think it can recover somewhat? Well, Anthony, I saw your question, and I know someone who's doing a bit of work for RCR, so I rang them up and to find out what's going on. And they, the reason they did the capital raising is because they lost $60 million or so on one project, which was the solar farm in Queensland, connected to Hayman Island and Daydream Island. Not actually on those islands, but on the mainland. It's called Hayman and Daydream Solar Farm. And they stuffed up the project due to cost overruns. It was simply that. Apparently some people working on the project were hiding invoices and not passing them up to head office. So head office, CEO didn't know what was going on, and the costs got out of control, and they had to do a write-down of $60 million or something. And that would have put them in breach of their debt covenants. And so they had to raise equity. And the equity, because they'd done a raising not too long ago, the underwriters absolutely killed them on the pricing of the raising. So it was that the equity raising had to be at a discount of something like 50 or 60%. And that was Macquarie Bank who did that. And so they absolutely got smashed in the capital raising, on the pricing of the capital raising, because, you know, they were desperate for money, because they would have had to go into receivership. They got the money. The institutions supported the capital raising. They're now in a retail part of the raising. My mate tells me that all the other projects are fine. It was just that one project. That one project is back on track and is just about finished. They fired the CEO. They fired everyone involved in that project. And they've now got $100 million cash in the bank. The banks have extended the working capital arrangements, and they've got $1.5 billion dollars worth of work on the books apparently, and they're bidding for. They've either just got or they're bidding for a project in New Zealand. So, bottom line is, it could be an opportunity really. I mean, the share price has gone absolutely tanked, as you say, got smashed after coming back from the capital raising. They were in a trading halt for quite a long time. Actually, there's no one I can interview actually because the CEO's gone and they haven't got anyone else yet. They've got a search underway, trying to find a CEO. Maybe I can. I'll tell you what. I'll try and track down this chairman. Maybe he or she, I don't even know who it is, will be prepared to talk to us. But that's the inside story from my friend who knows a bit about the company. They had a problem with cost overruns on one project. They fixed the project up. They've had to take a write-down on that project, $60 million or so, which they've done. They had to cover that with a capital raising, which they've done. The capital raising, the underwriters, Macquarie Bank and somebody else, murdered them on the price of the raising. And but they're okay. They've got the cash. Institutions have supported it. Don't know what the retail investors will do. But if you like the business of building solar farms, I reckon it could be a buy. Just saying. I don't know, but I'll chase them up for an interview. John says, what are your thoughts on Kogan as a long-term growth story? Is there still value there? The FY18 results numbers were amazing, despite talk of retail headwinds. Following on from that, Kogan directors sold 40 million in stock Tuesday and was wondering, when directors do this, is it generally indicative of something more sinister, or in this case, an overreaction by markets, which have sold down the stock 10% today? That was Tuesday. So, yeah, look, I'm in two minds about Kogan. I mean, I really admire Ruslan Kogan. I think he's done a fantastic job. He's a smart guy. He's built a terrific company from scratch, from the garage. And you've got to admire people who do that, honestly. But one of the things I liked about Ruslan was that he lived in a two-bedroom apartment in St Kilda. And he didn't have airs and graces. He just was focused on the company, and he wasn't particularly worried about the trappings of wealth, even though he got quite rich. And I thought, this is pretty good. It's a bit Warren Buffett-esque, who's still living in his old family home in Des Moines. But I read that Ruslan has just paid $38.8 million for a house in Toorak. I reckon that's airs and graces right there. And the reason he's selling all this stock is to pay for the house. So he's selling all his shares. So look, I think, oh God. So I'm worried about that, I've got to say. It's a terrific business, definitely going somewhere, but I don't like buying stock off directors and insiders in general. If they're selling, then in principle, so am I. I mean, that isn't always the case, because sometimes the directors and the executives are selling for a particular reason. In this case, with Ruslan, the particular reason is to buy a very, very expensive house. Now, I mean, he's going to rattle around this place, fair income. It's what is it? Yeah, $38.8 million. It must be a massive mansion. It's just up the road from Eloise Pratt and all the other rich people living in Toorak. It'll obviously be, a dozen bedrooms and 5 bathrooms or more. And I don't think Ruslan's even got a family. I mean, I don't know much about him personally, but I don't think he's got any kids. I think it's just going to be him in there, rattling around this bloody house. So yeah, look, I'm not too impressed with that. I'd be watching it and waiting, to be honest. Terrific company, but yeah, it's expensive too. That's the other thing is. Let's have a look at what their PE is. It's expensive. It's last time I looked. What is the PE? Yeah, 41 times, and that's trailing, right? So, I mean, maybe it's. I mean, the thing is, if it could be actually, if they double their profit next year. That could be a 20 times PE, in which it's fine. It gets back to the ratio that I've been talking about in the past. I haven't discussed it for a little while, but the PEG ratio, price earnings growth. And if the company obviously is growing rapidly enough, a high price earnings ratio is fine. A 40 times PE ratio is fine if they're growing at 40% per annum, which means a PEG ratio of 1 times. Yeah. Anyway, that's enough about Kogan. Vera says, a friend in Switzerland tells me that if Labor wins the next election, shareholders with less than 500k will not be subject to the effect of the dividend imputation reduction. Do you know anything about this? I'm in my late 70s. A few years ago inherited some money, and that has increased my assets to over 500k and have a similar amount in Rio Staff Super Fund. Okay, I can't give you personal advice, Vera. I just don't know about your own circumstances. However, I have heard that 500,000 thing, but I cannot find it in any of the policy documents. So I don't think it's right, actually. I think that now that it may be modified, and they have announced some modifications to it for pensioners in particular. But I can't find any reference to the idea that people with less than $500,000 invested won't be subject to the dividend imputation reduction. Maybe some subscribers can help out here. I've looked and looked, can't find it. So maybe I'm missing something or not looking in the right place. So bottom line is, Vera, I'm afraid I don't know. I'll keep looking. If I find something about it, I'll put it into the overview. This is a great question. Simrita says, in your opinion, what is the perfect retirement age? Usually the answer would be last year. Look, I don't know. Obviously, it's for everybody. I mean, Donald Trump's still going flat out at 72. Rupert Murdoch's retirement age is still to come, and he's in the mid-80s, you know. Some people don't ever want to retire. They just want to keep working until they die, and that's fair enough. I must say I'm kind of in that boat. I don't really want to retire. What am I going to do? I mean, I'm 66. What's my retirement age? You know, the way I feel is that I'm going to reassess when I'm 70 and think about it. You know, and maybe I'll feel differently then and say, okay, time to retire. But certainly don't feel like it at the moment. On the other hand, some people, you know, get some money, maybe an inheritance or something, and they go, righto, I'm retiring at 40. And for them, 40 is the perfect retirement age. So really, Samrita, it's very much a personal decision. You may be referring to the decision not to increase the pension age from 67 to 70, which Scott Morrison's just announced, the Prime Minister's just announced that. He had been in favour of raising the pension age to 70, which is kind of a different matter. But you know, I mean, I suppose it's a proxy for the retirement age. And as I say, I don't think 67, 70, it's all arbitrary. You know, it's still a matter for you as to whether you retire. I mean, obviously a lot of people have to wait until they hit 67 in order to get the pension because they can't afford to retire without the pension, which, by the way, is not supposed to happen because of the super funds. We've had mandatory super for 25 years, but people are still would be sent into poverty if the retirement age was raised by 3 years from 67 to 70. So I would say that's an indication that the superannuation system hasn't worked. Michael says, is a company like Appen, being a technology stock, safe in a downturn in the market, or would it suffer because of low cap value and high PE ratio? Look, on the surface, superficially, it would suffer. Appen's PE is something like 70 times. So it is a very expensive stock at a very stretched valuation, and if there was some sort of market correction, stocks like that would cop it. The only thing, the thing I'd add to that is that I don't know much about Appen, so I can't really make draw any informed conclusions about Appen itself, except to say that it's an expensive, stretched valuation. The very little I know about it is that it's in a wide range of technology businesses, but one of them, and it seems to be the main one, seems to be what they call content relevance, which is sort of, I need to find out more about this, and I think I probably should line up the bloke, the MD for an interview. But from what I understand, what we're talking about is something to do with search, internet search relevance at a enterprise level. So it's selling content relevance services to companies, big companies, and there seems to be a suggestion that it's a winner-take-all business. This, just as Google was, you know, there was whatever it was 15 years ago, there were more than a dozen tons of search engines. Google came along, and with its PageRank algorithm, and blew them all out of the water, and now has 90% of the search business of the world. So search became a winner-take-all. So the question is, and I don't know the answer to this, the question is whether this sort of what you might call souped-up search business of content relevance will become a similar winner-take-all proposition. And if so, is Appen likely to be the winner? Because if it is going to be the winner, what Google showed us is that it's cheap. 70 times PE doesn't matter. If it's winner-take-all and Appen's the winner, then it could be worth anything. I just don't know enough about it to say, firstly, whether it is winner-take-all, and secondly, whether Appen is the winner. I have read some stuff that say that Appen is in a good position to be that winner because it's all about the amount of data you've got, and so, you know, apparently Appen's got a lot of data, but and the trouble with a stock like Appen is that, you know, interviewing the CEO probably won't really do the trick, because he'll talk it up and say everything's fantastic and they are going to win. So, you know, but I suppose it's up to me to ask the tough questions, isn't it? So that's what I'll do. Jimmy says, what are your thoughts on ethical funds such as Morphic or BetaShares? I don't know about those specifically in terms of their ethical funds. I can only say, in general, ethics are in the eye of the beholder. There are a number of ethical funds around, and I think they all have slightly different approaches to what represents ethics. I mean, let's face it, there are some people in the world who reckon, a lot of people who reckon that an ethical investment is to invest in coal, because coal's good and that's what we should do. I'm not saying I agree with that, but most ethical funds don't have fossil fuels in them. They don't have gambling. Obviously, they don't have smoking, alcohol. So look, there's a number of ethical funds is just about what you exclude mostly, and obviously they do kind of then look for things that they support to invest in, but it's mostly about what you exclude, and everyone's got a different idea of what should be excluded. So I mean, maybe I should look up, see what their approach is, and do a couple of interviews with ethical fund managers to give you some guidance on you know, what some of these funds are doing. In general, I must say I'm in favour of ethical funds, because in general they tend to outperform the other funds, not by a lot, but a little bit, and that's partly because, you know, the stocks that are ethical, such as renewable energy and so on, have been and will probably continue to do quite well. So, you know. Jared said, I was just listening to the interesting MicroX interview, and as their name implies, seems to me their biggest differentiator is the size of the product. That is definitely true, Jared, sorry. Could be a huge game changer in my opinion. However, what I didn't get from the interview is how they have achieved similar better performance in a package that is 20% or less in size, i.e. portable. I understand the tech is subject to patents, but what they have come up with seems groundbreaking or revolutionary, or am I missing something? Are they truly the ones to have come up with this, the only ones to have come up with this, or are there others out there doing the same thing? Also, their association with Xinrui concerns me because we've all heard that China doesn't play by the patent rules and steal intellectual property. The whole point is that Trump is making. Your thoughts? Yeah, well, okay, so I don't fully understand the technology. It has to do with carbon nanotubes. It appears to be the case that they did invent it in Adelaide, and they do have global patents. And there are others who, I mean, I asked Peter Rowland in the interview about this, about whether there are competitors. He told me, you'll see it in the interview. He told me that there are others in the X-ray business who have smaller machines, but they're not anything like as small as his. So it is a game changer. It is definitely some sort of groundbreaking stroke revolutionary technology, that's for sure. But having said that, in general, hardware businesses are slightly dangerous, partly for the reason you mentioned, Gerard, which is that patents only protect you so far because China comes along and steals them. So that is a problem. And also the other problem with hardware is they can be superseded. Other people can invent something else fairly quickly that makes what you've invented obsolete. Whereas software businesses tend to be, a bit more enduring. So there are two sides to this, it seems to me, MicroX. I mean, I think it's a very exciting business, really interesting technology. It is definitely revolutionary, and it is an Australian invention based in Adelaide that they are taking to the world, and they've got a lot of interest around the world in it. On the other hand, hardware businesses like this are slightly dangerous because someone could either steal the technology or come up with something that's different and better, and then you're really buggered. So that's the caution that you've got to approach it with, which is why with any stock really, particularly ones like this, you don't put too much money in it. You don't bet the house on stuff like this because. On the other hand, look, what I like about it is he's going after multiple markets. So he's done a deal with Carestream, which is the hospital X-ray business, and they seem to be selling them, and that's going okay. And now he's working on airport security and X-raying laptop computers for bombs, which I think is terrific. Good on him. So yeah, look. That's about all I've got to say on that. I mean, yeah. Nicholas says, the FMG Fortescue share price seems to have been on a downward spiral of late, losing 40% over the past 12 months and 16% in the last month alone. Do you think it's currently good value near the $3.50 mark? Well, look, I thought I was a big rap for FMG earlier in the year because of their 10% yield, fully franked. I was talking about that as being a possible, a good yield investment. I thought they would cut the dividend. So did the market, obviously, but they cut it more than I thought. I think they've halved the dividend, so that was more of a cut in the dividend than I expected, and was also more than the market expected. So the stock's come down quite a long way, as you point out. It's currently on a yield of, what is it, 6.26%, based on the new lower yield, fully franked. Look, I think it's probably reasonable value. The problem that Fortescue has, difficult for them to do anything about, is that their iron ore is lower quality, so that they are getting a lower price, and when demand tightens up, they tend to, I think, lose ground faster than the others who've got a higher quality iron ore. Now, whether they can do something about that, I don't know. They're still working on costs. They've done a fantastic job on costs. I think it's a terrific company. I mean, I think that they've got a good mine, slightly lower quality iron ore, a good mine, and they're they've done a good job on costs. So look, I like the business. I always have. I think it's a terrific company, but obviously it's all about the future of the iron ore demand and what's going on with China. Three questions from Cara. Some elderly family members have an SMSF managed by an advisor. I think there are too little funds to make the costs worthwhile. Presumably they can transfer the funds to a managed super. Is it possible to move the remaining funds to an industry super fund? Do you have to be in the relevant industry, or would they have to go to a retail fund? Okay, so I can't really comment, apart from the fact that I can't give personal advice, don't want to. I don't know how much is in the fund, so but in general, my view is that you need at least 300,000 to make an SMSF worthwhile. Below that, you really need to want to have control of it yourself, and to be prepared to pay the higher costs, and believe that you're going to get a return that justifies those higher costs. So, I mean, that 300,000 cutoff is not hard and fast, but it's sort of a guideline, I would say. Yes, you can transfer the money to an industry super fund. In fact, I'd suggest that's what you do. But I presume if we're talking elderly family members, they're on a pension, or they're in retirement rather than saving. So it's a matter of finding a decent retirement package in one of these industry funds. Do not go to a retail fund. Absolutely not. On the whole, they're terrible, and they charge too much, and their returns are worse. The best performing fund in the country, this is for long-term savers. I don't know about I absolutely don't know about its retirement pension options, but I do, anyway, the best performing fund, according to the surveys, is Host Plus. UniSuper is also a good performing fund. According to the surveys, Australian Super is the biggest fund, Australian Super, and it's also a pretty good performer. Now, I'd suggest you go onto their websites or ring them up and see what their pension options are. But remember, this live stream is general advice only, not personal advice. May not be appropriate for you. Cara's second question. I agree with all the reasons you say that banks are on the nose going forward, and I'm quite pessimistic about the East Coast housing market. However, Westpac are now at a 5-year low and down 20% from their peak. At some point, they must become a buy. Any thoughts on where that would be? Or in other words, at what price is a pessimistic downside risk priced in? Well, look, it just depends on how pessimistic you are, Cara. I mean, I think it's possible to be very pessimistic about the banks, and to be more pessimistic than the current price would allow, basically because of the decline in credit growth that's happened on account of people have already borrowed too much, the decline of the housing market, which is likely at some point to lead to an increase in credit impairment charges, and thirdly because of fintech and the revolution that's coming. Oh, and also open banking, which I've been on about a bit. So, open banking is going to open all the banks up to much more competition. They have to hand over the data, their customers' data. That starts next year. And in the meantime, there's going to be there's a whole lot of new banks starting up. I recorded an interview the other day for the Radio National Money program by Richard Adey, and it's on tonight actually on Radio National at 5:30, where he's talking about all the new banks that are coming up, all the new digital banks like Shinjar and Judo and oh God, what else is there? There's a whole lot of them. So that might be worth having a listen to. And if you don't have time tonight, I'll link to it from the overview on Saturday. So that'll give you an idea. But look, I think the banks are in in all sorts of trouble, really. So yeah, I reckon that the banks, there could be more downside, is what I'm saying. And anyway, there's not a lot of upside, and it also depends on what you're buying them for. If you're just buying them for yield, you're looking for a reasonably high dividend yield, fully franked. Look, they probably are going to be okay. I mean, you know, it's not going to be like Fortescue where they cut it a fair bit at some point. I mean, if Fortescue and Westpac are both yielding the same, you'd probably, and all you're after was yield, then you'd probably go Westpac, and they are yielding the same, 6.7. Well, Westpac's a bit higher, 6.76% yield, based on last year's dividend, fully franked. So you know, if that's what you're after, then you know you probably that's probably reasonably secure. But you're not going to get a lot of capital growth, in my view. Where are we? Since your glowing report on BHP on the weekend, it's been hammered, down 5%, I think yesterday and today alone. Commodities are down in general, but BHP seems to be singled out for an extra whack. What's going on? And also somebody else asked about BHP and my piece in the weekend about it. Do I still think my comments are justified? Okay, so the reason the share price has fallen today is because it's gone ex-dividend. And actually the price has fallen less than the dividend, so it's actually gone up today. But yes, yesterday it went down a fair bit. I can't remember, it was like 2.5% or 2.3% yesterday, so a fair bit. And that was entirely due to metal prices the night before, all copping a hammering, copper in particular. So look, my view is on this sort of thing is you can't take any notice of these day-to-day movements up and down. Watch out for dividends going ex-dividend, which I get caught on all the time on the TV. I say that a stock's gone down, and then somebody writes in and says, "You idiot, it's gone ex-dividend." So you got to watch that. But also, they go up and down all the time by 2%, 3% because of commodity prices. And you know what that is traders, like often computer traders, just trying to punch the thing around. Because they all live off volatility, things going up, and BHP's a highly traded stock. So, you know, the day-to-day movements of a company like BHP should be just ignored, in my view. The long term, there are two things about it. There's a short term for BHP, which is 1 year, and we know that they're going to make a whole lot of cash this year. The forecast is for $9 billion cash from free cash flow from operations, and another $11 billion from selling the US shale results. And what Peter Bevan, the CFO, told me last week was that they don't need to pay off any more debt, and the free cash flow is really free, and their intention is to give it to shareholders. So the only question is whether that money gets paid as a dividend or as a share buyback. And what he was broadly hinting was that it'll be a dividend, because particularly for Australian shareholders, because they've got all these franking credits they need to use. Because being a dual listed company, they can't use the franking credits for their English shareholders. And so that means that they end up with more franking credits than they can use. So they want to give these franking credits to Australian shareholders. And so that's potentially $20 billion. Now, even if it's a bit less than that, because the free cash flow is a bit less, we're still talking in this 12 months, we're talking about a 15% or so yield from BHP, fully franked. The long-term picture is obviously there's that US shale cash injection will only be a once-off. The long-term picture is, I think, pretty healthy. They've got this potash business going on in Canada. They've got copper. They're expanding their copper. They're expanding iron ore. They're drilling for oil in the Gulf of Mexico. Unless China falls apart, BHP's long-term cash flow position looks pretty good. I think it's. Andrew Mackenzie's done a fantastic job with this company, and he's really turned it around. I mean, it was in trouble under Marius Kloppers. We never knew it at the time. Marius Kloppers wasn't any good, turns out. Andrew Mackenzie and Peter Bevan have fixed the place up. So, I mean, I'm a big rap for BHP. How are we doing? Michael says, I'm a Zenitas shareholder and I'm concerned about the fact that a director of the company has links to the entity making a recent takeover offer. Is this unusual? There are some other issues raised about the offer in the article below, and it was a live wire market. So if you're interested in the article, it's in Livewire Markets. Just go there and search Zenitas. Now, it's true. A non-executive director is connected to the bid for this business, and I don't like it at all. I think it's bad. But you know, there's nothing illegal about it. They're allowed to do it. It's a what is it? It's a scheme of arrangement type of offer, which means that it goes to a vote of shareholders, which means that they just need a majority of shareholders to approve it. And I think it's 75%, but it means that instead of it being 90% to get 100% of the business, they only need 75%. And you know, the price is, I mean, I think the thing was selling at the share price was about $1, and the offer is $1.46. So, you know, this offer is going to go through, no doubt about it. I think it's just going to happen, whether you like it or not. And I mean, fair income. I mean, it's not a bad price. Let's face it. I suppose it depends what price you're in there at. But if you're in at $1, then you're making quite a bit of money short term. But I don't think there's anything much you can do about it. Normally, I'd say if directors, insiders who know more about the company than you do, by definition, are buying, which in this case they are, then you probably shouldn't sell to them. You should probably buy as well. Buy with them. But unfortunately, in this case, you're not going to get a chance to do that because it's a scheme of arrangement offer that will almost certainly succeed. So I think there's nothing much you can do, Michael. You're going to be taken out at $1.46 a share. So I hope that represents a profit for you. Final question from David. Can you please explain if there is the difference between LICs and listed investment trusts, so a listed investment company and a listed investment trust, and the implications of the difference for low tax individuals receiving franking credits from LIT investments, such as within a pension phase SMSF? You know, this is a bit more technical than I'm capable of providing. However, the difference between an LIC and an LIT is that the LIC pays dividends because it's a company, and the LIT pays distributions because it's a trust. And a distribution is pre-tax, like you're responsible for the tax, so it'll be taxed at your marginal tax rate. So if your tax rate is 0, you're probably better off with an LIT, particularly after the Labor Party gets in, because with the LIC you're relying on dividend franking, and if you've got a low tax rate, you're relying on getting cash refunds. Now at the moment that's all fine. The company pays the tax, you get the benefit of that tax paid in the franking of the dividend. Listed investment trust, you just get the pre-tax distribution, and you have to pay the tax on it at your marginal rate, whatever that is. And if your marginal rate is low, or 15%, because it's an SMSF, then that's fine. So I think that's the key difference you need to think about. If it's an LIC, then it's coming in as a dividend, it's franked. If you're on a 15% tax rate in your SMSF, then you're relying on the cash refund, which is fine until Labor Party gets in. Just one more disclaimer to keep my licensee happy. It's general advice, may not be appropriate for you. And that's it for today. I'm going to head off to see Jay Kirby to do the Money Cafe. For Talking Finance tonight, I have done the interviews, and we spoke to Nikki Sava about politics, which was fascinating. Shane Oliver about the GDP number yesterday. Stephen Koukoulas talking about the market response to the GDP. I gave Tim Lawless a ring about the house prices for August, so he's taken us through the detail on that. And finally, Steve Sammartino, the technology guy. We talked about Amazon becoming $1 trillion business this week, joining Apple. So the two of them are $2 trillion businesses. And it's Roger Waters' birthday, Pink Floyd. So we've got a bit of Pink Floyd music in there as well. Not that I'm a huge Roger Waters fan. I'm a Dave Gilmour fan when it comes to Pink Floyd, but I do recognise Roger's qualities, if I can put it that way. Great to see you. Thanks for joining me, and I will see you next week.